you look at what Tether is really up to, right? It's like they're getting into trade finance. Once it gets into the energy and commodity system, that's like the next 10x. If this first phase is successful and stablecoins move from a few hundred billion to a few trillion, then the next leg up is when stablecoins move from a few trillion to like 10 plus trillion. I think it's important to think about the relationship between that and Bitcoin. The Treasury Borrowing Advisory Committee's forecast of a $2 trillion stablecoin market roughly implies somewhere between like a $300,000 and $800,000 US dollar Bitcoin. I think this is the tension, right, for Bitcoiners between the strategic alignment of incentives around this kind of monetary debt system kind of being recollateralized and Bitcoin kind of helping with that process, and how much freedom, right, will be permitted in that system.
Welcome back to the Bitcoin Policy Hour, a weekly podcast hosted by the Bitcoin Policy Institute. I'm your host, Zack Cohen, an associate with BPI, and I'm joined each week by my colleagues Matthew Pines, BPI's Executive Director, and Zack Shapiro, BPI's Head of Policy. Going to continue the shill here for the Bitcoin Policy Summit. We've just confirmed a great group of speakers that we'll be sharing in the coming weeks. Tickets are limited, and we expect to sell out. So if you want to grab your ticket, visit btcpolicysummit.org. All right, with that out of the way, we're going to switch up the format a little bit this week. We've been doing the kind of deep dives on some of the geopolitical stuff. We had a good rip on the AI stuff. This week we're gonna move a little bit more quickly, hit a couple more topics. So to get us started here, I'm going to kick it over to Zack Shapiro. It's been a busy week with a recent Brady letter in the Samourai Wallet case. So can you just let us know what that letter was? Feel free to add any sort of foreground to that too, but want to dig into that.
For sure. So I'll try and do the foreground as concisely as possible, but I think it is helpful to have the sort of full context of why this matters. So the way I like to start talking about this is by pointing out that Bitcoin succeeded where prior attempts at electronic cash failed, because Bitcoin was the first attempt at eCash to be truly peer-to-peer, right? That is what Satoshi solved for with proof of work. He solved the Byzantine generals problem and allowed people to reach consensus without having to trust each other. And so therefore, compared to the earlier attempts at eCash like DigiGold, eGold, Liberty Reserve, all of that stuff, moving Bitcoin on the Bitcoin blockchain is much similar conceptually to handing a physical dollar bill from one person to the other than it is like making any kind of electronic payment that existed before, all of which relied on some trusted intermediary to update a ledger and actually move the funds, right? When you move money on Venmo, it seems like it's happening instantly from your phone to your friend's phone, but really it's taking weeks to settle between correspondent banks, et cetera, et cetera. Okay. Why was this important? Principally, it was important because all the prior attempts at internet native money that came before Bitcoin were shut down, mostly for violating the Bank Secrecy Act. The Bank Secrecy Act is a law that imposes KYC AML obligations on types of businesses called money service businesses, one subset called money transmitters. And basically everyone who attempted to do eCash before Bitcoin was deemed by the government a money transmitter, and they were shut down and oftentimes criminally prosecuted. Okay. In the early days of Bitcoin, it was sort of unclear who, if anyone, in the Bitcoin space was a money transmitter and had obligations. One of the big questions was around exchanges. So the part of the US government, FinCEN, which is a subset of the Treasury Department that deals with illicit finance, put out guidance first in 2013 saying, yes, Bitcoin exchanges are money transmitters, right? They are holding funds on behalf of their users. They're transmitting funds on behalf of their users. The Bank Secrecy Act says you're a money transmitter if you accept and then transmit funds on behalf of the public. So exchanges need to KYC. But then a whole bunch of other business models popped up. The ICO era happened. People started building interesting wallet infrastructure, custodial wallets, non-custodial wallets, multi-sig, mixers, tumblers, all sorts of interesting stuff. So again, in 2019, FinCEN put out more detailed guidance looking at a bunch of different business models and saying which of these FinCEN thinks are captured by the Bank Secrecy Act, which of these business models constitute money transmission and which don't. And to all the sort of well-versed lawyers I know who looked at that 2010 guidance, there was a through line in the guidance where what we would call custodial tools were deemed money transmitters and what we would call non-custodial tools were not. And I say what we would call, because the language that FinCEN uses is hosted versus unhosted. So FinCEN says, for example, a hosted wallet where you have just an account with the wallet provider where you're not holding Bitcoin directly, you're not interacting with the Bitcoin network directly. They're holding Bitcoin on your behalf, they're sending on your behalf, and you just see a number on your screen. That is a money transmission business, and they have to KYC you. However, a non-custodial wallet, which is just a piece of software that allows you to generate private keys and hold your own Bitcoin, perhaps using your own node to do the transactions, that's not money transmission because it's not a service that's being provided. No one's holding your funds, no one's accepting and transmitting. It's just a piece of software. Okay. This guidance was foundational for the Bitcoin industry. People built all sorts of non-custodial tools where you could not KYC your users even if you wanted to, because it's a piece of software that people can go out there and use, and there just isn't a means to surveil them if you wanted to. And there were prosecutions of people who violated the Bank Secrecy Act with their custodial tools. The first very famous one was Charlie Shrem, who ran a company, a custodial Bitcoin on-ramp and off-ramp called BitInstant. And he didn't KYC his users. Turns out some of his users were from the Silk Road, and he went to prison. Similar prosecutions against Bits Lotto listeners might remember from 2022. This was the main prosecution against CZ. And no one was really up in arms about those. The Bank Secrecy Act, we have lots of opinions on, but is the law of the land. This all changed in 2023 with the Tornado Cash case, and in 2024 with the Samourai Wallet case, where for the first time, not FinCEN, but the Department of Justice, federal prosecutors in the Southern District of New York, took the position that they could prosecute software developers of non-custodial software tools for failing to register with FinCEN as money transmitters. So this does not keep with what most lawyers thought the guidance meant, right? If you're writing software, you're not accepting and then transmitting funds, so hard to see how the government could make out this case. And what really looked like was going on in these cases was we're at this juncture where Satoshi, through creating Bitcoin, created the situation where we have meaningful peer-to-peer electronic transfers. The Bank Secrecy Act and surrounding laws and regulations were written at a time where such thing wasn't possible, right? There wasn't a concept of actual peer-to-peer payments electronically. You always needed a trusted intermediary. And so there's this clash where the law presumes there is going to be this intermediary you can regulate as if it were a bank. There is no intermediary. And so now these federal prosecutors, for lack of an intermediary, are just throwing the software devs in prison. So this is, first of all, an intolerable situation because it's unfair and a violation of due process and fair notice and all sorts of things to put these people in prison. But also, much more concerningly, the precedent that it sets for anyone building software in the Bitcoin space. If the Bank Secrecy Act doesn't require you to custody funds, and the FinCEN guidance we either misunderstood or was bunk, that is essentially a ban on direct use of the Bitcoin network and development on the Bitcoin network in the United States. So really worrying. So anyway, these cases were going forward. Tornado Cash was further along. The government argues, listen, the guidance really talks about these things as services, not as tools, et cetera, et cetera. And this all sort of went along until April 7th of this year, when the incoming administration, through the Deputy Attorney General, Todd Blanche, put out a memo saying, listen, really DOJ, right, the criminal law enforcement arm of the executive branch, should not be in the business of regulating where the Bank Secrecy Act does or does not apply, right? Congress wrote this law. To the extent that there's ambiguity, first, if there is a live dispute about it, that can go to the courts. But if there's not a live dispute, it really should be the agencies, specifically the expert agency FinCEN, that decides, and it shouldn't be federal prosecutors that tell you what the new version of this rule is by putting you in prison. And the defense counsel and the prosecutors agreed to a pause in the proceedings in the case, so the prosecutors could decide whether their continuing with this prosecution was in keeping with the Blanche memo or whether they needed to dismiss the case. At the same time, the prosecutors, after a direct sort of compulsion from the defense in what's called a Brady request. So Brady is an old Supreme Court case that says if the government is prosecuting you and they are in possession of evidence that's exculpatory, meaning evidence that makes it look more likely that you're innocent, they have to turn over that evidence to you. The defense here said, listen, we think there might be exculpatory evidence about, what FinCEN actually thinks. So prosecutors, did you ever talk to FinCEN about this? 6 months, or I guess a full year into this case, and a year and a half after this conversation happened, the prosecutors say, actually, yes, 6 months before we started this prosecution, we did go to FinCEN. We showed them the code behind Samourai Wallet. We explained how it works. We said, under the FinCEN guidance, is this money transmission? FinCEN said no, and no because it's only money transmission if you have custody or control over funds, which Samurai Wallet didn't have, which Samurai Wallet's lawyer told them, was the rule, and that's why they didn't have to register with FinCEN. What most competent lawyers in the space understood the rule to be is also what FinCEN thought. And the government said, thank you very much, waited 6 months, brought this prosecution anyway, arrested the developers, and then hid this for the first year of the case. And so, this is a pretty shocking revelation. I think it's vindicating for, those of us who have been pointing out what we, knew the FinCEN guidance to mean the whole time. And it really lays bare that there is no way to interpret this case now other than explicit, not only regulation by enforcement, but regulation by indictment or regulation by criminal prosecution, right? The Department of Justice was explicitly trying to expand the reach of the Bank Secrecy Act, not through statute, not through the democratic process, not even through regulatory rulemaking, where you would have a public notice and comment period, but by throwing people in prison and, trying to win in court. And so, where it stands now is the case is still paused, but it's been paused for a month. And my view at this point is if the government was going to drop this case of their own accord, they would have done that. And so I think that is unlikely to happen. And so the thing we're really looking at now is the what's called main justice. So not the local U.S. Attorney's Office, which is like a law firm for the government that does cases, but the higher ups in D.C. Are they going to intervene and say, President Trump put out an executive order saying that America is going to be the crypto capital and a safe place for developers. And the Department of Justice put out this Blanche memo saying we're not going to do regulation by prosecution, and we're not going to go after, developers of software for what their users do. And we're not going to do these sort of wide reaching anti-money transmitter criminal prosecutions. And the prosecutors are doing it anyway. Are they going to step in and say, all right, enough is enough. You need to stop with these cases?
Yeah, I mean, I think to go a little further into the kind of main justice SDNY situation here, right? I think there's a precedent where SDNY has this sort of like feud, you might say, with main justice, right? Where they sort of feel the need to assert their independence, you might say. And so what, I think one thing that we're pushing on, and Zach, you can add a little bit more color to this, is Blanche memo comes out, right? Pretty obviously from our perspective, right? The Samourai Wallet proceedings would fall within the things that the Blanche memo says we're not going to do anymore. And so the question is the Southern District of New York going to kind of push back on that? Are they going to keep pushing on this? Or are they going to kind of fall in line? And I think one of the things that we might do to kind of apply some pressure onto this case is say, this is like a pretty clear cut example of insubordination from the Southern District of New York, against main justice. AG Todd Blanche, like, are you going to stand for this, right?
Yeah, I mean, at this point, it just, I think very clearly is insubordination. It looks like they are not going to back down from this position. The Blanche memo is quite short. It's 4 pages, but in those 4 pages, it says, we are not going to continue the Biden administration's regime of regulation by enforcement. We are specifically not going to do that with 1960 charges, which is what the unlicensed money transmission charge in this case is. We are not going to do that against software developers, and we're not going to do that against specifically software developers, what they call mixers and tumblers. The Blanche memo to me reads like it is just directly about Tornado Cash and Samourai Wallet. So any argument that falls outside the scope of the memo is ridiculous, and it is just insubordination at this point. Yeah, the Southern District of New York, I mean, the nickname for the office is sometimes the Sovereign District of New York. They are very good at finding expansive legal theories, where something that happens in Azerbaijan has some connection. There's like what's called a jurisdictional hook where it went through a computer somewhere in New York. And so for some reason, we're having this prosecution in Lower Manhattan. Although I don't know that there's always that much tension between, main justice and U.S. attorney's offices. I mean, this is an interesting sort of like civic question that we're, litigating right now in American politics about independence of executive branch agencies versus, all the power flows through the president. But unlike the Fed, where I think you can make at least a colorable legal argument that the Fed legally has independence, ultimately it is just by convention that U.S. attorneys tend to have independence from the Department of Justice. I don't think there's anything legally backing that, right? The president can get rid of U.S. attorneys. The U.S. attorneys do answer to the attorney general. The attorney general does answer to the president. And when the Department of Justice, as they did in the Blanche memo, says here is our administration's priorities. Here's what we are and are not going to do with our criminal law enforcement apparatus. I think it is incumbent upon federal prosecutors who are wielding the immense power of the state to put people in prison to listen to that, because otherwise, you really do worry about democratic accountability.
Yeah, cool. One final question before we jump topics here, and Pines, you're welcome to jump in. What are some other ways that pressure can be applied here, right? I think there's the Senate Judiciary Committee. There's an avenue there. What are you looking at on this?
Yeah. So look, first, I think people need to understand this issue. I think this is the most important Bitcoin or crypto legal issue out there right now. If the precedent goes the wrong way in these cases, and this is not like a law getting passed where like you see it coming and it's up for a vote. If federal judges come out the wrong way, we can be in a situation overnight, and that is the direction we are still headed in, absent some sort of intervention here, where the law of the land is that the Bank Secrecy Act doesn't require custody or control of funds, and therefore individual at-home node runners and Bitcoin miners and software developers of all kinds and DeFi front ends and basically everyone who's building stuff in Bitcoin and crypto can be thrown in prison for not doing something that they're not able to do, right? They can't register with FinCEN because FinCEN wouldn't think that they are money transmitters, and the technology does not allow you, because it is just a software. It doesn't allow you to create the sort of surveillance apparatus that the Bank Secrecy Act requires of money service businesses. So this is like a real sort of existential threat to crypto in the United States. And the other way we know this is because our sort of biggest opponent out there, Elizabeth Warren, figured out that the way she could create a sort of covert Bitcoin ban that didn't call itself a Bitcoin ban is the Digital Asset Anti-Money Laundering Act, or DAMLA, which attempted to ban Bitcoin and crypto by just declaring that all of those actors I just mentioned are money transmitters. And she knew that they couldn't comply with that, and it would just push the industry offshore. So we can get to the worst possible, parity with the worst legislative outcome imaginable just by ignoring the federal court. So first, I just want people to pay attention to and care about this issue. The other thing, besides appealing to the executive branch here, which I think is the sort of shorter term fix for these cases, there is a bad ruling to this effect already in the Tornado Cash case that would stay even if the prosecutions went away, where Judge Fela in that case ruled that the Bank Secrecy Act does not require custody or control, and that is outstanding. And so, there is a lawsuit out there, supported by Coin Center called Llewellyn versus Garland, which is attempting to fix that precedent. But the longer term fix here is the passage of a law called the Blockchain Regulatory Certainty Act, which just puts into federal law that the Bank Secrecy Act doesn't apply to non-custodial software. And it would make that clear once and for all. And that would take it out of the courts and out of the regulatory agencies. And, that would just fix this weird, moment in time we're in, where we have, genuine sort of peer-to-peer non-custodial new technology meet the sort of teeth of the old, Bank Secrecy Act surveillance apparatus, and it will help harmonize the two in a way that will allow, Bitcoin and crypto technology to work. So, the other thing you can do is talk to your elected representatives, make sure they've heard of the Blockchain Regulatory Certainty Act, perhaps try and explain to them what it does and why it's important. And, none of this is to say that we like money laundering or we like criminals, or that's a good thing, or we can't pass reasonable laws, maybe even pass reasonable laws about the scope of privacy tools. But the solution here is not just to bulldoze the distinction between a financial service business on one end and software on the other, because if we do that, the collateral damage is going to be everything we have worked to build here. It's going to be everything that separated Bitcoin from the failures that came before.
I mean, I just let Zack cook on this stuff. The chef is in there. He's cooking it up. I would say, just making a larger commentary, Zack, to your point, the other Zack, is a distribution of priorities in, like, say, the broader kind of Bitcoin ecosystem seems to be not right size to what I think are the critical issues here, right? Like a state level crypto and gold reserve bill, gets thousands of likes, whereas like these in the trenches judicial attacks on like the core premise of holding and using Bitcoin in the manner in which Bitcoiners believe that they have a right to use and hold it, that's front and center. And just because the national leadership and the political rhetoric is certainly decisively shifted in a pro-Bitcoin direction doesn't mean that there's a lot of legacy inertia in the judicial system that is quite threatening, and that you have to kind of meet it head on. And by the way, those opponents didn't disappear, right? They've just sort of fallen to their kind of backstop positions. And as Zack Shapiro can attest to, the mask has fallen a bit in terms of like the battle lines here, and the sort of pretense of what is motivating, right, this disposition, this hostility, right? And so I think it's very clear now, like, where this is coming from, and it's not going away. And the opponents of freedom technology, right, like, they didn't just like give up or put their swords down. They are looking for these asymmetric sort of levers and cases to still pursue their objectives here. So I think sort of patting ourselves on the back and saying job's done, Bitcoiners have won, would be a strategic mistake.
Yeah, and before we get to the sort of mask off moment of the week, which is its own interesting saga, to the number go up people, one of the things we love about Bitcoin is that it really aligns important interests, right? It creates virtuous cycles. Bitcoin is number go up and freedom go up, and that's what we love about it. Like, you can do good and do well, and that's awesome. However, there is a flip side to that, which is that the freedom go up type of stuff, right? The ability of Bitcoin to actually be peer-to-peer electronic cash is upstream of getting to the $1 million a coin that we're on the trajectory to, right? The reason why Bitcoin is valuable, the reason why Bitcoin is going to be $1 million a coin, in the next decade, is that it is digital gold, and it's digital gold because of its credible scarcity, because the fact that it can't be confiscated. And if we start compromising on those principles, we actually lose the fundamentals that Bitcoin has as an asset class that make it differentiated from everything else out there.
Yeah, we don't want just $1 million a Bitcoin pet rock that can be seized and censored at the government's discretion. We want a $10 million Bitcoin that can route around and flow like water in a global system between individuals and AI agents and businesses that are adding value to a productive economy. And these sorts of in the trenches bureaucratic and judicial obstacles and major political opposition aren't going to disappear along that trajectory.
All right, let's dig into the uncovering from the week. The people who don't want us to to reach the world that Pines just described.
You got to do that in your DJ Khaled voice. They don't want us to pass the Genius Act.
Oh my gosh. Okay. Yeah, let's dig into it. Pines, what went down this past week that we want to talk about?
Well, I'll defer to Zack. He was the protagonist. I was just an observer from the sidelines here. So I'll let him kind of give the TLDR.
Yeah, I was a little bit of the antagonist, sort of throwing tomatoes from the sideline. But so the big drama in DC this week in digital asset land is around the passage of the Genius Act. And the Genius Act is a federal stablecoin bill. We've talked about this previously, but it's meant to provide regulatory clarity, integrate stablecoins more into the financial system, and create consumer protection. So if you're holding a product that markets itself as a stablecoin, it actually is stable and fully backed by dollars or dollar equivalents. There had been back and forth that we've talked about involving Circle and Tether and how we're going to treat domestic versus foreign stablecoins. And it looks like everyone sort of reached a compromise, late last week or early this week about what the bill finally was going to say. And I think that's what we talked about in a previous episode. And it is, meant to come up for a vote today, when we're recording this podcast yesterday, the listeners are going to know what happened, and on a glide path to passage. Then 9 Democrats wrote a letter defecting, Democrats who had previously said they were going to vote for the bill. And, they made 2 arguments as to why they are not going to vote for it anymore. One is the Trump family's World Liberty Financial is apparently doing a stablecoin that is going to get Saudi investment and be on Binance, and that we can't possibly pass stablecoin legislation when the president might corruptly benefit from it. And the other argument, somewhat bizarrely but very in keeping with I think the conversation we're about to have, is that the AML KYC obligations under the Genius Act were not strict enough. So very quickly on the corruption point, at least my view on this has been, if you want to pass laws stopping government officials from financially benefiting from their decisions, fair enough. Write that law. Torpedoing the bipartisan compromise stablecoin bill doesn't seem like the right recourse here. The analogy is like the Trump family also develops real estate. Lots of people, especially on the left, have alleged that they are corruptly benefiting from that, especially with the Trump Hotel in DC. But that doesn't mean that we should intentionally create shitty housing laws to make it impossible to build homes because we're worried that the president's family will benefit from real estate development. It's really the same conversation with stablecoin bills. So good policy is good policy, and then if you want to deal with corruption, that should be a separate issue. Turning to the KYC AML, I noticed a post on Twitter from the former chief of staff, so Gary Gensler's chief of staff of the Gensler era SEC, who characterized the Blanche memo that we were just talking about as the Department of Justice giving up on any kind of anti-money laundering enforcement and just, embracing criminals. And I pointed out that doesn't seem to be a terribly accurate description of what the Blanche memo says. And perhaps you should, take a look at the text of the Blanche memo. And we had this long back and forth where, this person who previously held a lot of power, right, really was one of the chief crypto-related enforcement officials in the United States government, doesn't understand or care about this custodial or non-custodial distinction, really seems to be politically motivated to, gum up the works of the digital asset industry at every available juncture, whether that is, stablecoins. She's retweeting regional banking regulators that, are worried about stablecoins because people might prefer them to bank deposits, which should be telling, really bad faith attacks on software developers. And, it is sort of amazing. And some of the attitude here, especially with the rhetoric that we're seeing from some of these former Biden admin officials, is that there is this, sort of ideological anti-crypto perspective that seems to be more motivating to them than specific, well thought out policy considerations, right? I think there are some issues in Bitcoin and crypto where there can be a reasonable debate about what is the right thing to do. And, can the industry go too far in some of its priorities? And has the industry behaved badly? And I think in a lot of those cases, the answer is yes. But it's really hard to have a, helpful, nuanced conversation when you're dealing with an administration. And this is a reminder that we were dealing with an administration for 4 years that just kind of hated the industry and wanted it to go away and was using sort of antagonistically whatever hooks it had to intentionally create bad policy and stymie the adoption of this new technology, which is, like AI, it's coming no matter what. It's not, I guess, not surprising, but still shocking to see this out in public in a way. I think some of these individuals were less willing to straightforwardly say when they were holding government positions.
Yeah, and one other sort of riff that I would add on top of that, right, is away from the theatrics by some of the opponents, right? There's a lot of strategic stakes on the line when it comes to the stablecoin legislation, right? I'll point to remarks by Secretary Bessent when he was giving his testimony, where he was summarizing the results of a TBAC presentation. So the Treasury Borrowing Advisory Committee was charged to essentially study the impact of stablecoins on a wide variety of kind of more market structure elements in the USD kind of global and domestic financial system. And they did a very serious, like, in-depth analysis. The most in-depth analysis, the most kind of definitive statement of kind of their policy kind of market analysis to date on this topic was just released on April 30th. And it's called Digital Money. And I'm encouraged, folks to like flip through the deck, right? Because it actually has some really interesting statements in there, right? In particular, a forecast pending certain assumptions around the passage of the Genius Act, that the total sort of stablecoin market supply will increase from roughly $230 billion today to $2 trillion by 2028. It's like an 8.3x increase. And they also point out that right now about 120 billion, I have to go check the numbers, 120 billion of that market cap is basically held in T-bills. And so they forecast that to increase to about $1 trillion in T-bill supply, held on the balance sheets of stablecoin issuers. And so $1 trillion is like anywhere from, I think it's about a $6 trillion total T-bill market. But that amount of issuance is like almost the U.S. government's like annual issuance of T-bills. So this is the Treasury Department essentially forecasting the growth of these balance sheets in a fashion where they become a strategic demand source for U.S. debt, right? And this is something that BPI has written about for years now as like a forecast and a strategic potential. And in particular, the relationship between Bitcoin and stablecoins is quite tight, right? Like the correlation between the overall growth in the US dollar price of Bitcoin and the amount of US dollar stablecoin liquidity is like, depending on how you do the correlations, anywhere from 60 to like 80%. The causation is probably multifaceted, right? Like overall global liquidity creates additional buying power for Bitcoin, but endogenous demand to hold Bitcoin requires people holding stablecoins in order to intermediate those transactions, which are like 70 to 80%, on stablecoin rails. And so this is this flywheel that the U.S. Department of Treasury and the Treasury Secretary himself is like pointing specifically at, and they want to, as a matter of policy, sort of engineer this linkage between digital assets in general and U.S. sovereign balance sheet. And they even in the deck, use the term USD hegemony, right? How stablecoins can expand the dollar system outside, and they make a analytic assessment that the something like a Genius Act would have probably a net neutral effect on the domestic U.S. dollar money supply, right? Because people might be doing marginal substitution of checking account deposits to non-interest bearing stable coins, which then have to reserve themselves as sort of fully reserved issuers. The real expansion of the US dollar money supply is in the offshore system, where stablecoins can also play this interesting function, not just as a medium of exchange, right, for parts of the world where there's lots of frictions to use the dollar in everyday commerce, but as a form of collateral, right? Because it's a stable token that has a dollar symbol next to it. You can use this as essentially collateral in offshore dollar transactions, which frees up a huge amount of additional kind of demand and overall market activity around and in the dollar, right? But bypasses kind of the traditional kind of hierarchical corresponding sort of banking systems, and in particular sort of bypasses the foreign central banks and kind of creates this this separate network that you can imagine. The legacy network was kind of hierarchical. All the dollar payments get cleared through chips and the New York Fed, and then swap lines help ensure the stability of the global Eurodollar system, which are IOUs essentially on the balance sheet of non-US banks. But essentially they're rehypothecating that collateral. And if they get into any sort of trouble, if there's any sort of run risk on those dollar claims, their national central banks have to bail them out with dollars. Where do those national central banks get those dollars from? The Fed. So you can imagine this, like, think about like a network growing, right? You have the legacy kind of hierarchical banking system that sort of is managed through the Fed, but uses global central banks as its kind of as its agents. This is the Treasury Department saying we want to help nurture the growth of a kind of a systems bypass or an alternative network that goes sort of straight to those markets themselves. And I think there's, at the same time, right, like impose a bit of financial repression on those holders of that dollar token overseas, because at least in the current framework, there's no interest bearing kind of stable coins allowed. So this is like the strategic stakes, right? This isn't like a onesie twosie little few $1 billion. These are talking trillions of dollars and a material portion of the U.S. government's debt servicing over the next few years.
Yeah, man, I'm sure you have more developed thoughts on this than I do, but I was thinking a lot about what is the relationship between stablecoin proliferation and the Eurodollar system. And so probably some of our listeners will be familiar with what the Eurodollar system is, but really it is using dollars abroad, not directly as a medium of exchange or store of value, but actually either as a, depending on the terminology used, as a unit of account to price things in, or a standard of value, I think is the more accurate term for like what you want to be paid in the future. And it creates all of these IOUs. And no doubt that does create some demand for treasuries abroad, because if you have a lot of dollar denominated liabilities, a bunch of IOU that you're pricing in dollars, you do need, at the end of the day, dollars to pay for them. And that relates to a lot of stuff we previously talked about on the show relating to Triffin's dilemma and, creating demand for dollars abroad and why we send pieces of paper overseas in exchange for physical stuff. And it also creates this sort of, quite popular meme in Bitcoin macro land about, dollar milkshake theory, in that, when you have a sovereign debt crisis, the dollar actually holds up quite well and appreciates greatly relative to other fiat because everyone has dollar denominated liabilities, and there just is a natural shortage of dollars. But it seems like when instead of just basically countries through the euro dollar system being naked short dollars, having dollar liabilities that they may or may not have any collateral from, they actually have the thing. They have a bearer instrument that is one-to-one backed by dollar or dollar equivalents that can, both be the medium exchange and the store of value, and is very different than just dollar IOUs. Do we think that this changes any of the dynamics of Schriffin's dilemma, or changes the dollar milkshake theory, or any of these things that people are worried about, like the status of the dollar itself as a wrecking ball?
I mean, that's a complicated, multifaceted kind of macro finance plumbing question. I'd say, just stepping back, there's already been some structural shifts, non-crypto related, right? In the move from LIBOR to SOFR, which you can imagine moving from an unsecured to secured and an offshore to an onshore kind of global dollar system. So that shift's been sort of years in the making. It was sort of started under Trump 1. And it's been, kind of a successful kind of monetary restructuring in terms of how the U.S. government has kind of embedded demand for U.S. Treasury securities in the global Eurodollar system, from being sort of naked IOUs that were sort of very, very lightly collateralized, meaning you could sort of rehypothecate the same Treasury security, to expand liquidity in the offshore dollar system. And that created, a lot of elasticity in that system, but also meant it was prone to run risk. As soon as there was a hiccup in some, in the global economy or in some even regional economy, they became, the scarcity of dollars, either because overall economic activity goes down, they just, trade falls, and those dollar inflows are not sufficient to support that stack of IOUs, right? Then people scramble for the dollars, and that kind of creates the sort of dollar milkshake cycle. Of course, that's not like a problem that the folks managing the system were unaware of, but it was like a hard thing to kind of shift. And so the first step in shifting that was kind of moving to SOFR, secure overnight financing rate, which basically, it's a long, complicated story, but essentially is designed to sort of shift the marginal dollar kind of transaction to a secured standard, where you have to have a piece of collateral, essentially. And so that structurally increases the amount of demand for Treasury securities, right? So essentially lowers the overall kind of leverage in that offshore system, but it doesn't make it go away, right? And so then stablecoins are kind of now coming into that environment as a new thing. 2 trillion is a lot, but compared to like the total stock of outstanding debt, it's still maybe 10% of that market. And so will it have this sort of strategic impact, shifting the balance of how most trade happens? This is, I think, a really interesting, maybe like conservative assumption that T-Back doesn't get into, which is, you look at what Tether is really up to, right? It's like they're getting into trade finance, right? They've already started to think about issuing letters of credit for oil trade, right? And so that is where you move from this being a stablecoin market, principally, for crypto on and off ramps, and then, marginally going into cross-border remittances, and then maybe for tokenized, sort of exchange with, a stablecoin onshore market. Once it gets into the energy and commodity system, that's like the next 10x, right? And so that would be, maybe in the 2030s, right? Where if this first phase is successful and stablecoins move from, a few $100 billion to, a few trillion, then the next leg up is when stablecoins move from a few trillion to like 10 plus trillion. And I think it's important to think about the relationship between that and Bitcoin, right? Because if you just think about the elasticity and kind of liquidity multiple associated with that correlation, I mean, the Treasury Borrowing Advisory Committee's forecast of a $2 trillion stablecoin market, if you assume all else equal, roughly implies somewhere between like a $300,000 and $800,000 US dollar Bitcoin. So take the middle estimate, that's 500,000 Bitcoin, $500,000, Bitcoin price. This is essentially the implied Bitcoin price by the US Department of Treasury's stablecoin forecasts. Now, of course, if you put another 10x on top of that, you get to a very different world where essentially the US is kind of re-architecting a digital money system that is designed to sort of structurally graft it to the legacy dollar debt system, but recollateralizing it, right? And also allowing, its rails to penetrate around the world and kind of lock people into a system that, from a certain perspective, right, it is represents our values. I think this is the tension, right, for Bitcoiners, is that the Genius Act, right, like requires that the U.S. government be able to like fully surveil, burn, seize and freeze any stablecoin transaction globally, right? And they can't do that for Bitcoin. and so this is going to be the next tension here between the strategic alignment of incentives around this kind of monetary debt system kind of being recollateralized and Bitcoin kind of helping with that process. Everyone's on board with that. I think where the strategic and kind of security interests may start to diverge is this perspective on how much freedom, right, will be permitted in that system, or will be negotiated in that system, right? And that's, to a certain extent, like someone using a sort of local banking app that allows them to hold dollars for the Nigerian bank. Like, well, the Nigerian bank, right, reports the Nigerian government, and sometimes those governments are extremely authoritarian and freeze and block, dissidents. But if that marginal Nigerian is now holding, a fintech app that is on an open blockchain, but that's issued through, a Genius compliant US stablecoin issuer, well, now there's gonna be a new source of like control, right, over those populations. That's not, localized in the Nigerian government. It's gonna be localized at OFAC in DC. And so there's gonna be a whole new set of questions about how do we extraterritorialize responsibly in a manner that respects our interests and our soft power, this new capability, right? And to what extent does Bitcoin play like a check on that, right? Because ultimately folks will hold some amount of their wealth in stablecoins. But I think increasingly, that will also go with more wealth being held in Bitcoin. And where do these other technical developments with Bitcoin, whether it's Chime and eCash or other kind of privacy preserving technologies and layer twos, do they start to kind of now displace some of the functions of stablecoins over time, right? And I think that there's a very interesting set of path dependencies around here that will have a lot of implications for just how much of kind of this ethos survives this transition, or expands as along the way. But I think that's one of the crux of the issues that BPI is going to be focused on in the next few years.
Yeah, great. Okay, before we move on to the next topic, just want to put a little question out to the two of you. As the Genius Act gets voted on, do you see that in any way as sort of a bellwether for the other kind of crypto initiatives and potentially for the strategic Bitcoin reserve in Congress?
Maybe. I mean, certainly that's the narrative out there right now in Washington. If we, my hesitation about this is like the strategic Bitcoin reserve and the market structure bill are just quite different things. The stablecoin bill, should not be terribly controversial. Stablecoins are legal now. No one's going to stop using stablecoins who's using them now if this bill doesn't pass. This bill allows traditional conservative institutions to get into the stablecoin game, and it provides more robust consumer protections, which I think causes some of my frustration at the politicization of it. It just seems like this one should be pretty easy, even though it's maybe not earth shattering, right? It doesn't allow yield bearing stablecoins. It doesn't fix a lot of the systemic issues in the Bitcoin and crypto markets, but why not, right? We have American companies that think stablecoins are really important to use on their back end. We know that abroad stablecoins are really important as a way of getting people access to dollars who don't have access to the traditional banking system. If we can't get this done, then maybe that's a bellwether about either crypto's power or the sort of deleterious effect on politics that the Trump family's personal dabbling in the industry has had. And so there, yes. But I guess what I would say is the reverse. I'm not so like, I think we may have sort of political challenges around the Bitcoin Act and around market structure, even if this bill goes through for that reason, right? Those are sort of much more directionally taking a view on the industry. And in the case of the Bitcoin Act, it's directionally taking a view that like we think is right and super important and should be not controversial. But the merits of these legislative attempts are pretty different from each other.
Okay, great. Next topic here is going to be a recent report that we published earlier this week, Pines, can you just tell us first who Matthew Ferranti is, and what the findings of this study were?
Yeah, Matt, we're just collecting Matts. Matt Ferranti, Dr. Ferranti, is a PhD from Harvard who joined the intelligence community as a in-house economist a few years ago. And he's been a fellow with BPI. His views that he presents on BPI's website are not the views of the intelligence community, to be clear. But he's an economist with an acute interest in Bitcoin, especially the kind of geopolitical dimensions of Bitcoin adoption. So he wrote a blog post called "Who's Been Buying Bitcoin?" Right, and it's kind of a simple premise, which is you can use sort of time of day analysis to look at what's the Bitcoin price. What does the Bitcoin price do when U.S. Market hours are open versus foreign market hours are open, and can you draw any kind of conditional inferences about the nature of the the demand pattern over the past few months? And so he kind of did that analysis, kind of building on analysis that a different think tank had done for gold, right? To look at how gold demand was sort of shifting over different time periods and, making some conditional inferences on, is this, foreign demand driven by geopolitical risk? Is this shifting investor appetite? Is this just, other sort of drivers? So it's like, we should do the same thing for Bitcoin, and Bitcoin might even be a bit cleaner to do such analysis because you don't have to deal with as much of variability on the supply side. A lot of it's just basically either policy driven or sort of market sort of animal spirits. And so a few conclusions he came to, or at least like four sort of time periods that he looked at and drew some conclusions. So what was like pre-election Bitcoin returns were dominated by demand from foreigners. Then during the pre-inauguration Bitcoin returns, so like between the election and Bitcoin, it was about even, but both net positive returns, demand for Bitcoin. And then after the inauguration, but before the SBR executive order was signed, U.S. hours showed a much stronger demand for Bitcoin than foreign hours. So maybe speculative demand coming from U.S. citizens thinking about a shift in U.S. policy. But then after the SBR executive order was signed, until the Liberation Day announcements, you saw increasing demand more from foreigners than from domestic buyers. Again, kind of interesting observations. I think worth taking a look at the blog. Some cool charts here. But it does, stepping back, right? Like it's very clear that a lot of folks are interested in not just in the Bitcoin price, but like who's buying Bitcoin and why, right? And for most of Bitcoin's history, the answer to that question was always, oh, the institutions are coming. The institutions are coming, right? Oh, this is coming from Wall Street. This is coming from, high net worth individuals. This is coming from, legitimate sources of capital. And that was kind of the main sort of narrative anchor for most of Bitcoin's history as it sort of was maturing as an asset class. The last, I say, 6-12 months, that question has now been, are nations buying, right? Are sort of sovereign wealth funds buying? Is this sort of geopolitical narrative that's been bubbling up around Bitcoin, does it have legs, right? How much of this is just, noise, but versus how much of this is actually an indicator of a strategic evolution? So this white paper doesn't, or this blog doesn't necessarily answer all those questions, but it's useful indicators of some of the data points to look at there. And the fact that it's being, written by a well-respected economist at the U.S. intelligence community, right, should be a clue. And I think it goes with, I'm not saying this is related, but it's an indicator of this shift. The deputy director of the CIA just did an interview with Pompiliano, and he specifically remarked upon the U.S. government's shift in a pro-Bitcoin direction and stated explicitly that this is part of the technology competition with China and our rivals that we need to lead in and not be laggards in. And so you have the deputy director of the CIA, which doesn't normally talk about much publicly, let alone on a topic, kind of as, novel as Bitcoin, coming very, very, forcefully out in favor of the U.S. government leading in this technology competition that he sees Bitcoin as a core element of. So yeah, I just see this as data points that point in a certain direction.
Yeah, I mean, I guess the larger question here too, right? We're knocking on 100K right now. We're recording on Thursday, May 8th. As we expect Bitcoin to be, of increasing geopolitical importance, as we expect, this sort of geopolitical situation to continue to become more fraught. Is this sort of an indication that Bitcoin is going to continue to play that role in the geopolitical sort of world? And larger question here, and feel free to take this however you want, but does that basically mean that like foreigners are going to start buying more Bitcoin, and maybe we see number go up because of that particular reason?
I mean, the answer is yes, right? But I think the question is like how far and how fast, and by who. And I think some of the points to sort of think about, which is one, like there's a global economic and kind of monetary reordering happening as we speak, in which Bitcoin's adoption is taking place. And so you have this very aggressive, somewhat unprecedented series of policy kind of guns to various countries' heads, saying, are you with us or against us? Get off the fence, make a deal. And the U.S. government's trying to sort of re-engineer like a new term, a new sort of set of global economic and security terms. And they're going around to every country and saying, like, this is the new deal we want to sign up for. And that is having effects on currencies and reserve asset decisions being made by lots of countries, including legacy allies and other sort of middle powers and rivals. And so I'm expecting it to be the next few months to have an acceleration of those sorts of reorderings, right? So there's a whole series of meetings taking place starting like last month, right? JD and in Rome, like a whole bunch of people were in Rome at the same time. There was the leaders meeting at the Munich Security Conference just this past week. There's going to be a very important meeting with Trump and Mohammed bin Salman and other Gulf countries in Riyadh in about a week in mid-May. Also happening this week is a 4-day meeting between Xi and Putin. There's going to be a big NATO summit. There's going to be a G7 summit. There's going to be basically it's going to build up to like an APEC leaders meeting in October, where I expect if things go in a certain trajectory, that would be when Xi and Trump kind of meet, right? So like your theory of the case about Bitcoin's role as a geopolitical asset has to kind of be anchored in what you think these larger reorderings and like grand bargains, how do those get settled in the next few months, really, right? And I think in general, like you're seeing a lot of liquidity now come back into the system, so that Bitcoin is responsive to that. But I think the next like true strategic pivot will be, to what extent does the U.S. government kind of hint more explicitly at its pro-Bitcoin stance, not just as a rhetorical matter of holding its coins, but what does it choose to signal as it makes these decisions about these budget neutral means of acquiring additional Bitcoin, which, as we talked about in previous episodes, kind of span the gamut from kind of somewhat trivial signaling efforts to like truly strategic multi-billion dollar buys. And I think that's the regime we're in. So I think this is not going to be like a multi-year thing. It's going to happen pretty much between now and the end of the year. And so Bitcoin will be extremely volatile, I think, along that process. I think it will likely go up, but it will be a nonlinear function, and it will be a function, I think, principally not just of the traditional sort of liquidity drivers, but of these like more structural strategic drivers, which come down to like decisions made by a handful of national leaders, and they can cascade pretty quickly.
Okay, great. All right, last topic. We've got a couple more minutes here. We had our first state level strategic Bitcoin reserve bills passed in New Hampshire and Arizona this past week. I think broadly speaking, this is amazing news, right? Like this is what we wanted. But Zach, is there any more nuance here that we should be aware of?
Yeah, I mean, first of all, there is this threshold question of what you can reasonably call a strategic reserve bill. The New Hampshire bill authorizes the treasurer to invest up to 5% of general funds in Bitcoin or crypto with sufficient market cap or precious metals. Doesn't create buying, but it adds Bitcoin to a list of assets that the state can hold. And I think that's definitely something to applaud. I think that is a step in the right direction with public investment in Bitcoin. But to me, that looks less like, what I would call a strategic Bitcoin reserve than what happened at the federal level, which is actually creating this vehicle administered by the government for the long-term, safekeeping of the government's Bitcoin. And, it remains to be seen what, if any, buying there will be, but a step in the right direction. Similarly, in Arizona, you have Bitcoin, being now an asset that could be invested in. The state will keep Bitcoin that it has from enforcement actions. There might be mechanisms to do buying in the future. So I view these more as an interesting bellwether of how sort of states view Bitcoin. I think it is a step that, a sign that the Overton window is shifting in the right direction, that Bitcoin is becoming, more of a mainstream macro asset that's used in the same sentence as, gold and silver, which is definitely great. But it's more of that than I think it is, heavily consequential policy outcome.
One point I would make on that, just in the larger context of a lot's happening, and something that's hard to keep up, because you have this this assessment of the path of Bitcoin adoption at the sovereign level, U.S. and around the world, which we just talked about, U.S. adoption at sort of the state level, but then you also have U.S. adoption at the corporate level, right? And that, Saylor's just holding this conference there, and in theory, like that sort of adoption can happen much faster once the right conditions are in place. And you could just see that maybe the conditions are in place. And I was really struck by an announcement done by Strive. So Matt Cole gave a presentation there, and he articulated this strategy where there's a lot of like zombie companies out there that actually are valued less than the cash on their books for like, kind of arcane reasons. And if you just have the liquidity to acquire those companies, right, essentially for 90 cents on the dollar, with the explicit objective of then using that cash to buy Bitcoin, it's essentially, like a leverage, like you basically can acquire like a whole company's balance sheet at a discount and then deploy that straight into Bitcoin. That seems like a really like novel idea. I don't know how successful it's going to be, but that's how you get billions of dollars of new like buying power from like one company's kind of acquisition strategy here. And those can be kind of self-perpetuating to a certain extent, given how many of those sorts of companies are out there. And I think it's going to all happen in parallel, right? And so these individual dynamics of corporate adoption, state adoption, sovereign adoption, as well as the larger retail adoption that's going to take place now that you have banks now permitted to do spot trading. I think it's pretty soon Morgan Stanley via E-Trade is going to allow that. Charles Schwab. So it's just like a whole bunch of things are all kind of a whole bunch of taps are kind of being opened up at the same time. Individually, right? Are they going to be the thing that moves the needle, strategically? But in combination, it looks to me like you have all the conditions in place for kind of a strong reflexivity. And it's hard to predict how that will go. But I think policymakers, like, getting back to the point about the SBR, right? It's kind of seen as a sort of third priority kind of behind market structure and stablecoins right now. And, we obviously support the stablecoin bill, but it's been our contention that, SBR is sort of the rising tide that lifts all boats. It's the common point of consensus across all the relevant, industry stakeholders. And it's the one that I think is most cleanly aligned to our strategic national, interests here. And that the time is now. Like there is a certain window of time that opportunity can slip away from you, right? That strategic leverage and asymmetric upside for the U.S. government's balance sheet and its strategic advantage decays, right, at a faster rate than, say, getting market structure bill right, or kind of the marginal relocation of a dev to Dubai, right? Like, from a certain perspective, the things are in place right now to really accelerate the global adoption of Bitcoin, and the U.S. government doesn't get its act together, it could miss this strategic opportunity. And so this is why we are laser focused on advocating for the SBR and finding as many means as possible to kind of get this in front of legislators' eyeballs, recognizing that the political economy right now, with the lobbying attention on these two bills, it makes it kind of hard to break through. But we want to put the conditions in place for when attention is directed, that it's a very clear alignment of incentives and interests and strategic objectives here for the SBR. And so that's where we're not losing sort of sight of that. And I think it takes on renewed urgency as we go through the summer.
Amazing. All right. Thank you, gentlemen. We'll see everyone next week.